Hello and welcome. You're watching KYC. I'm Hersh Sayta, and we're going to talk today about JK Cements. It's interesting. Why? Because cement pricing is undergoing a large change, and JK Cement is at the forefront of that. It is benefiting more from volume growth than pricing. Operational efficiencies have started to kick in. The EBITDA per ton has gone up 25+% both sequentially as well as YOY, and therefore you're seeing a strong expansion, and that's a feature of Q4. It's also been one of the top buzzers in terms of cement stocks over the last year or so. So first off, I want to talk about cement pricing. The pricing uptick, sustainability, as well as how it will impact the numbers. We've spoken a lot about pricing. Less has played out than what has been anticipated. Let me term it as that. And maybe we'll get better perspective when we speak to the guest we have today. The second one is with regard to your EBITDA per ton. I did say that it's gone up by 25% both sequentially as well as YOY, so you're seeing very strong growth. Now EBITDA per ton is a beat in Q4 versus what most analysts were penciling in, even some of the more bullish ones. And therefore, this one stands out. The third piece is I want to understand how the cost-saving measures are going to impact the numbers. They're doing roughly 150 to 200 crore of cost savings now, and that will well start reflecting on the numbers because the bottom line is at around 1,000 or sub 900 crore, and therefore that cost-saving element is going to start building up in the numbers. I want to also talk about plans of expansion, and there are some very strong plans that they have, whether that can play out. The other one is with regard to debt. Now, in terms of the debt outlook, its debt to equity is 1:1, which is one of the highest in the industry. And given its size, or maybe the second highest in the industry, and especially among the large players, and therefore you want to look out for that debt number. While you're not looking at a sizable debt to market cap, but your debt to equity is quite sizable. So that's something that you want to look out for as well. And what can we expect in terms of PAT growth over the next 3 to 4 years? That's what I really want to understand, because we've seen 3 to 4 years of sluggishness. Can you see strong compounding maybe over the next 2 to 3 years in terms of profitability? All of that, and we'll try to break it down and try to get it for you over the next half an hour. Let me first start off with what this company is about. As the name suggests, it's a cement manufacturer. Manufactures grey, white, both types of cement as well as wall putty. I will explain some of these products in a slightly more nuanced fashion. It's also into all the other ancillaries, paints, tile adhesives, wood finishes, construction chemicals, all of those. So it actually covers a whole range of products within the construction basket. So great play with regard to construction. But mind you, one thing I want to flag off, the largest chunk in terms of console top line as well as profitability is cement. So surely that's the one key focus area which we will also focus much more on, because that's the key element, the key product within the entire basket that JK Cements tackles. Let's talk about geographies. In terms of where its presence is, it has plants in all of these geographies across India. Of course, more of those coming in the next slide as well. All of these. So what we're seeing is there's a geographic concentration in north and central, and more northwest and central. You're seeing Rajasthan as one of the geographies. You're seeing Gujarat as one of the geographies, UP, MP, and then you have one piece of presence in Karnataka. You also have Haryana. So predominantly that is the focus in terms of geography. It also has a presence in UAE and Africa. So among countries, India, UAE, Africa. That's the way in which it's structured. Let's look at the journey now. 1974 was when the company was established. 1975 is when they commissioned their first plant in Rajasthan, which is Nimba Hera, is where its first plant was set up, still continues to be its largest. Let's also look at, in fact, now let's zoom out. 1984 was when it sets up JK White, which is the white cement manufacturing facility it has. 2002, it sets up the wall putty manufacturing facility that it has. 2009, is they're setting up the Mudapur plant, and thereafter 2014 international presence starts off in UAE. It also in 2016 sets up the wall putty plant in Katni, and thereafter more capex done, large one in 2020. Aligarh in UP and Gujarat, all of those were done, which were both grey cement plants. Now let's talk about capacity, and this one has ambitious plans with regard to capacity. The current capacity is 24.34. They're planning to double this over the next 5 years. So 24.34 million tons per annum. Anywhere that you see MTPA is essentially million tons per annum. The white cement capacity is around 1.12, and the wall putty capacity is around 1.33. So that's how they are stacked up. Now let's talk about the differences between these three products. First is the grey cement. It's the most common type of cement. It's used for general construction. It provides strength and durability. It contains limestone, clay, iron ore, and that's what it's used in its manufacture. And it's relatively less expensive compared to the other two. So that's on grey cement. It's your plain vanilla cement which you're seeing in construction of both roads as well as buildings around you. So you can see that. Now let's talk about white cement. Now this is the more nuanced angle of it. It's a decorative cement, more used for decorative finishing, architectural designs. Materials that are used within the white cement manufacturing are low on iron ore or on iron oxide content, and that's where it gets its white color from. It's more expensive to manufacture. It's a more refined cement, and therefore it's slightly more expensive. And you see the white cement capacity is far lower than the grey cement. Now let's talk about wall putty. Once you've put in the cement in construction, you need to level the surface. So typically before painting, when you're leveling the surface, there's a white semi-liquid which is splashed on to the cement construction, and that is wall putty. Now this is used as a filler or leveling agent. It's used on walls before painting, and it fills in cracks, holes to level the surface out. We'll just focus on these three products because these three are the predominant products of JK Cement and the larger contributors to profitability for the company. Now, let me quickly go across to KYC parameters, and let me quickly zoom into metrics that we'll try and cover today. We'll start off with the income statement, thereafter the balance sheet, the cash flow, the return ratios. We'll also look at shareholding, street cred, street coverage, and valuations. So we'll look at all of those, and we'll try and get you the rating at the end of all of this. And joining me today to help me break this down is Puneet Javeri, who also now covers cement. Puneet, you want to start off with the income statement?
Well, definitely. You know, it's been a decent performance for the company in this particular time frame. FY25 was a decent year because the pricing environment was a little volatile, both in the north and especially in the south. Now, since the company largely operates in the northwestern as a central, as you rightly said, Hersh, we've seen a 14% CAGR in terms of revenue over the last 3 years, while EBITDA has grown slightly lesser, and that's largely because of, for cement companies, there is the fuel cost, which is the major one, power and fuel cost, as well as the freight cost. Now, JK Cement has been trying to get their hands on that and get on top of that essentially to reduce costs. So we've seen that kind of EBITDA margin being decent, 17.1%, but the company's performance can definitely improve going forward. But for now, we've given this a neutral rating largely because of comparing it with peers. The efficiency isn't there yet for the company. It's comes in the top 5 to top 6 players in terms of capacity. So they will have to nail down the cost effectively once the capex is done. But we've given this neutral based on relative peers' better performance.
Okay, yeah. So neutral. You want better growth there, Puneet, I believe, and maybe that's the real question is, are we at an inflection point to achieve that? Because you're starting to see EBITDA per ton inch up and quite substantially, and therefore you might well be underway. Also, I was reading, and maybe you can correct me if I'm wrong, the EBITDA per ton is very close to Ultratech now,
yep.
Where, or rather is even better than an Ultratech. If I remove India Cements and the like from the Ultratech, from the entire consolidated numbers, and therefore you might well start to see an inch up there.
Yeah, definitely. It's getting to where the 1100 per ton mark in terms of EBITDA per ton, which is one of the common metrics for the cement industry. The other aspect is, I think the market is also looking at what's come below as well, because the company's debt is higher, and we'll get to that in a bit. So that's why we see the valuation differential between someone like an Ultratech, JK Cement, compared with other players like Shree Cement and Ambuja. But they are largely there in terms of performance of EBITDA. Once the costs start coming up and the interest cost starts eating into profits, I think that's where the differential is, and we'll get to that in just a bit of
Yeah, let's look at the balance sheet. In fact, we're well placed to look at that. The shareholders' equity is around 6,100 odd crore. So that's the cumulative equity. In fact, the debt equity currently stands at 0.99. So your net debt to equity is obviously lower because there's a cash element to it. Let's pull up the cash balance as well. Not looking bad at all at nearly 1,400 crore, but there's plenty of capex in the pipeline as well. I did mention, and two things that one needs to know well about the cement industry. One is it's very, very capex intensive, right? And the second is that typically a cement plant will provide cement only in a specific or limited geography, typically. And that's because of the very high transport cost that cement entails. And therefore, when you saw all of those names of those plants, it's largely to enable quicker and better and more efficient distribution. But at the same time, it's a very capex intensive sector as well. So a couple of things to keep in mind, which is why the cash bank balance may be overlooked by some on the street. But when you're looking at the debt to equity, it's 1:1, which is high, or rather the second highest in the large cap or the slightly larger players. Among slightly larger players, it's one of the higher debt to equity ratios that we are seeing. But cash flow, Puneet.
Well, cash flow has been a positive surprise because, we spoke about the growth that's been largely missing. Now, within cement, the key aspect, of course, is a lot of moving parts. How the company is, producing the cement in terms of efficiency of fuel cost and power. We spoke about that. The company is trying to get more efficient there. Waste heat recovery, among other measures that they're looking at. When you look at the cash flow and the financial side of everything, they have been able to improve over the last 3 years. So cash flow from operations is 1,900 odd crores, and that's significantly better in this year compared to the last years as well. So we've seen the company improve its cash flow from operations, consistently over the last 3 years. Between somewhere around FY21 to 22 is when they started that project to start looking at that number very closely, and that's helped the company in its net cash flow improvement as well of 33% CAGR over the last 3 years. So definitely a lot of measures done to improve those two metrics, Hersh, and hence we've given this a thumbs up.
Yeah, absolutely. And you look at a couple of other metrics along with the other numbers that we've put out. Cash flow is around 2,000 crore. The debt level is at around 6,000 crore. And therefore, it will take maybe 3 years of free cash flow. Also, I did mention that it's capex intensive. So you use some of the cash for fresh capex. There's also a large depreciation number as part of the P&L because it's capex heavy. So certain things, again, within the income statement, the balance sheet and the cash flow that you need to look for when it comes to both cement companies and JK Cements in particular. But let's look at return ratios, because you need to invest incrementally higher amounts of capital. So you want your ROC ratio to be good, and this one actually is. And I give this a thumbs up purely from a perspective that you look at some of the other cement companies, and I'll just point out some peers. And Ultratech has an ROC of around 12%. You have an ACC, which is also at 12.2%, which is one of the highest ROCs in the industry. So this one has a decent return on capital employed. It has a good record for that. And with an inch up in EBITDA per ton, which has happened in Q4, you might well see an upside to this ROC metric. And that's why we've given this a thumbs up. Puneet, shareholding.
Well, shareholding, largely, again, not too much to, the promoter holding is slightly below 50%, and that's why I think, Harsh, we've given this a neutral rating. But we've seen very strong interest coming in from domestic investors as well as foreign investors, largely because the industry is at a very key inflection point right now. We've seen pricing not being in control. This year was the first year where we actually saw some increase in pricing for players like JK Cement. Now, the other key aspect is that valuations also were largely in favor sometime in the last year. Over the last year, the stock has moved over 40%. So you're seeing that valuation now very comparable to its large cap peers. But growth for companies like JK Cement as well as JK Lakshmi Cement, the other player there, the number 5, 6, 7 in terms of capacity have a higher growth since they are adding new capacity. As well as trying to get cost and control. So the market is giving a slight premium, if not the same valuation, to someone like JK Cement as well, and keeping that faith in the management to turn around the business on all metrics. Right now, there are some cylinders that are firing, and I think that's the key. But Harsh, I think largely the promoter stake below 50% is the reason we've given it a neutral, right?
Yes, absolutely. So typically, I mean, we generally give neutral rating when a promoter holding is below 50, so that is one. But the promoter holding is quite stable. The other piece is with regard to a couple of funds, Puneet, that have sold out. Fidelity is reducing its stake on a consistent basis. At its peak, it had a 6% stake in the entity, now has just about 3.6 and is gradually reducing its stake in the company. You have a Kotak India mid-cap fund which has also reduced its stake from 1.4 to a 1.2, maybe a minor one, but nonetheless something to keep in mind. You also have a Mirai which has given up, and a DSP which has given up some of its stake or some of its holding within the company. So you want to look out for some of these trends, which is why we've given this a neutral. The run-up in the stock price could well be one of the reasons why they've done this. But they've trimmed some of their holdings, and which is the other reason why we've given this a neutral. Now, in terms of, so that's in terms of return ratios. Let's talk about street cred now, and let's try and zoom into how the stock has done, because that'll give perspective to what I'm talking about. 17% 1 month returns, year to date is 30, 6 months is 29% returns, 12 months is 41% returns, and it's a 5-bagger in the last 5 years. So it's created tremendous wealth for shareholders. No reason for a shareholder to complain if they've held it at any point of time through this rally. So it's been great in terms of shareholder returns, Puneet.
Well, definitely, and it's reflecting in the street's faith essentially in that aspect as well. And I'll just quickly highlight the street coverage part of it as well. 23 buy calls for the company, a very decent analyst coverage. The only reason we've given this a neutral rating is also because of the potential downside. Actually, analysts largely penciling in the growth, saying that the growth over the next few years, or maybe in the medium term at least, is largely priced in. Valuations also currently very stable at that. So let's move on to the valuations as well, and then we'll complete the discussion, because for someone like a JK Cement, they're largely trading almost at 20 times EV by EBITDA. Let's move on to the next one. Let's show valuation very quickly. And the other players, interestingly, are also in a similar bucket. So you see something like an Ultratech, Shree Cement, they're already at 20 times EV by EBITDA. JK Cement, again at 19. We've seen something like an Ambuja also at 17.5. The capacity expansion is happening, really heavily across the industry. We've also seen a lot of consolidation in the industry with acquisitions from Ultratech, as well as from someone like Ambuja as well in this particular time frame. And of course, there's a disclaimer that the channel you're watching is owned by NDTV, and that is largely owned by the Adani Group as well. Ambuja ACC also part of the larger Adani Group. But overall, the valuations have been essentially pricing in the growth that is going to come in the next year. What is also interesting, Harsh, and we saw in the last 1 month movement, was because the Q4 was very surprisingly good, beating analyst estimates. And I think that's why we saw that sharp run up in the last 1 month specifically. But largely it was pricing in that, the high single digit growth. And I think they surprised street with a double digit growth. But currently valuation penciling in most of those metrics, as well as capacity expansion, among other things right now.
Yeah, absolutely. So that's kind of summing up everything, and let's put it all together. Those are all our rating parameters and the neutral or thumbs up that we've given to each of them. Again, what stands out is no thumbs down on this one. So that's the other piece, and in all, we've given this a 5.5 on 8 on our ratings. Let's quickly go across. We're joined in by Rakesh Arora, who's the founder, GoIndiaStocks.com, and a good, credible voice with regard to cement, because it's tough to catch this management. So Rakesh, talk to us about, first off, welcome, good morning. I want to first understand from you how you view JK Cement in terms of both growth as well as this inflection we've seen in EBITDA per ton in Q4. have the upsides, or has the stock run ahead of itself, or do you still see value in this one?
Okay, so see, there are a few things why we like JK Cement. One is that they've grown very aggressively in the last 2-3 years, and they are on verge of completing another big expansion. So if you see their capacity was around 14-15 million ton in 22, and they are ending 26 at 30 million. So in 3-4 years, they are doubling their capacity. So which was a big highlight for them. Number two is that they are into regions which are perennially, short of limestone. So Central India is one where they're expanding currently. North India has always been a very high price market. And they have little bit in South India, around 12% or so. But that too is in, Karnataka, which is kind of bordering Maharashtra, which is a better price market, even in an oversupplied market like South India. So they are operating in, much higher price markets, and that's why, their margins are much better than some of their peers. The third thing that we like about the company is that they have extended into a kind of total building material space, I would say. So they already had white cement and wall putty. Now they're extended into adhesives, paints. So it gives them a probability of expansion of the product category going forward. So apart from the cement growth that they are seeing, they have these categories to grow also. So overall, I would say that high growth and category expansion. Now add to that, they've spent quite a lot on branding. So their cement used to sell at a much higher discount to leaders like Ultratech and Ambuja. But they've been able to spend on marketing and brand building. They had to do in any case when they were launching all this paints, etc. So they've been able to narrow down the differential to the leaders, and that is what is really showing up in their better EBITDA margins, and that's why the street is getting a little bit surprised on the results. So overall, from a fundamental point of
Rakesh, I'm
view.
sorry for interrupting, but is this elevated pricing set to continue? You're going to have a robust monsoon, likely. It's already underway. Do you believe pricing can stay elevated at these levels?
So seasonal dips are definitely going to come. You can't really wish those away. So prices are going to dip during monsoon because demand goes down 20% below the yearly average. So you have surplus capacities and surplus production during that time. And but having said that, if I look from a whole year as a perspective, the competition intensity in the industry is going down. You have, kind of top two leaders, Ultratech and Ambuja, who have kind of settled down now. They've done their spate of acquisitions, and their last round of acquisitions were all in South India, so which is one of the highest surplus market. And now we are seeing a lot of attempts to increase prices. So having done all those acquisitions, the top two leaders want to increase price. The third leader, Sri Cement, if you see in the last 6 months, has been disappointing on volume. They are focusing more on premium cement and margin. So the Sri Cement, which was once known for low price, high volume strategy, is also shifting gears. So if you have top three players who are kind of settling down and want to increase price, I think cement is in for a good time from a yearly perspective. Seasonally, obviously, there will be some ups and downs.
Got that, Mr. Arora. Mr. Arora, very good morning. Thanks so much for joining in. It's Puneet this side. I just want to, have just one specific question, because you've seen the EBITDA per ton grow over 1,000 rupees for this year, and the Q4 was largely a surprise, over 1,200 bucks. So I think that the question is that if you can just contextualize for us, how should we look at JK Cement in that context of strong EBITDA per ton? But the debt part is also something that's worrying because of the capacity expansion that has been there over the last 3 to 4 years. How should we look at those two metrics together? Because the cash flow from operation and net cash flow has generated very well in the last 3 years.
So EBITDA per ton for JK Cement also includes white cement, where the margins are much higher. So around 100 rupee per ton, you can adjust for that. And since I was mentioning that they are largely into North and Central India, which are higher price market, I mean, the limestone availability in Central India is very limited. So they will continue to enjoy these kind of, high margins. Even the recent acquisition in J&K, there the margins are 1,500 rupees per ton. So they are, focusing on high margin areas. So for next 2 to 3 years, I think they should. So this year they averaged around 1,000 odd for the full year, 1,200 for Q4. But I'm expecting that they would average around 1,200 to 1,300 for the next 2 years on their, full production.
Rakesh, two questions. If that were to happen, what will the profit growth be? Because the last 3-4 years in terms of profit growth has been slightly on the sluggish side. The second question is debt a concern at all for you?
Uh, so let's take the second question, the easier
Sure.
one.
Sure.
That is not a concern
Okay.
because net debt is hardly anything. They have a lot of cash on their books. And secondly, they would be doing a bit of in excess of 2,000 crore. And that is what is their capex guidance also for next year. So they will spend what they are going to earn. They are not likely to increase their debt too much, but their earnings continue to grow up as capacity utilization keeps going up. So debt is definitely not of concern at all, and they just have to say that they need capital, and the market would flood them with capital. So let's forget about that. That's not a concern at all. Now coming to earnings growth, so obviously last year the EBITDA margin was around 1,000 rupees per ton. This year I'm expecting around 1,200 or so for them. So probably 20% increase in EBITDA comes from just the margin expansion, and around 10% increase will come from their volume growth. So you can expect around 30% EBITDA margin growth for the company. I am not sure where the consensus is building 30% or not. I haven't looked at the consensus numbers, but probably that is what the stock price is already indicating.
Mr. Arora, just one question from my side. We've currently seen, the expansion, as you mentioned, from 14 million tons to almost 25 now. The management is targeting to double that by FY30 as well. But that's, in terms of, only Ultratech was already on the expansion drive, and with the acquisition, they're already at 200 million ton. You spoke about ACC Ambuja as well as Shree Cement. Do you think that in terms of somewhere it could hamper the kind of margins that the company has, because you will have to utilize those plants with that effect? Or do you see that the market will grow essentially so much in the next 5 years that it will be able to absorb so many players, the expansion, and not hamper margins for something like a JK?
So, you can grow like 100, 200 bips higher than the industry if you're trying to have a organic growth strategy, which JK Cement is following. So if, for them to grow from 30 million ton where they will be in FY26 to 50 million ton in FY30, it's possible. But, volume will not grow at the same pace. I think volume growth would be closer to 7-8% for them. Until unless they make some acquisitions to reach that 50 million ton, they will not be able to grow at double digits. So the capacity they might be able to put in because you need 3-4 big plants to come in. That again I doubt because they aren't really prepared for that as yet. Their expansion in Panna is just completing in 26, so maybe they might put in another line there. But Odisha, the limestone is not yet clear. And Jaisalmer again looks slightly far away. So I think it could get delayed by 1 or 2 years, and then it will fall in line with the industry growth rate.
Okay, Rakesh, one word answer. Your favorite stock in the cement space at this point?
I'm not at liberty to say that.
Okay, okay, fair. All right, we'll
But
let you
you
go on
guys are
that note. Thank you so much
close
for
to
coming
that
and
group.
speaking with us.
Okay.
Out of time, viewers, on this edition of KYC. Stay tuned.